Thank you, Rob. Good evening, everybody. As you heard earlier from Jason during the introduction, our esteemed CEO is under the weather, so I'm pinch hitting tonight. And I have to tell you, there's nothing like presenting someone else's PowerPoint slides on last minute notice. But I'm game tonight, and there is a lot of material that I need to cover off in a short period of time, so we'll jump right in. I know you're going to be a very kind and patient audience to me tonight, so here we go. All right. I'm going to begin this evening by talking about asset allocation. And more specifically, I'd like to take a look at what's going on underneath the surface of our clients' investment portfolios. Secondly, you heard some comments earlier from Rob on Vancouver housing, Crackshacker Mansion. I'm going to provide some additional comments on housing, as well as give you an update for our investors here this evening on our two real estate limited partnerships. On the equity front, although Canada may be facing an economic headwind, perhaps the surge in energy production in the United States may prove to be a real game changer for U.S. equities. And lastly, taxation. Jason, I will make this exciting. I'm going to finish with some comments on taxes and budgets and what this might mean to some of your financial and estate plans. All right, let's start with asset allocation. All your eggs in one basket. I think all of us know this is not good diversification, especially when all your eggs look the same. On the other hand, I imagine that this is the type of asset allocation my kids would prefer. Much less of an emphasis on stocks and bonds. And that's no different for us. Less of an emphasis on stocks and bonds, and as Jason covered off in the introduction, a very broad asset class diversification across a lot of assets. But in addition to this, and equally important, we want to ensure that at least 80 to 90% of all of these assets are paying our clients a cash flow for owning them today. Not promise of future growth and promise of future cash flow, bird in the hand. We want you to get paid today. Ideally, we want our clients to keep their capital invested at all times, and with the cash flow for our clients who are retired, that provides you with a lifestyle. For those that aren't retired, you're taking that cash flow and you're using that to acquire more of these assets at opportune times. And lastly, Jason did cover off a much lower exposure to publicly traded equities in this environment. So, looking at this from a top-down, big picture perspective, let's imagine we're making a client recommendation, and here's where we're going to start. First, we'll begin by recommending to this client that they hold 18% in real estate. In addition to the real estate, we're looking at 35% in equities, 40% in fixed income, and 7% to alternative strategies. All right, what's underneath the surface? Well, it's really important that real estate pays rent. We want income. In addition, we want to ensure that there's income on the equities coming from options and dividends. And of course, we want to ensure that there's interest and dividends coming from fixed income. And when you look at all of this as a system, combined, we want to make sure that this type of portfolio is producing 4 to 5% yield or income on total capital invested. Drilling down even further, let's start with the fixed income side. We're going to begin with an allocation of that 40%, putting 20% of that to your domestic standard bonds, 10% to global bonds, 10% to high yield bonds, first mortgages, second mortgages, preferred shares, and lastly, cash. There's varying degrees of risk here, as Rob covered off in one of his last slides. But when you look at all of them again as a system, on average, they're producing roughly a 4% yield across the board. Let's shift to alternatives. On alternatives, you can expect little to no income. What we're hoping for out of this category is some growth and inflation protection. However, because they don't pay an income and we feel it's truly important, alternatives will always be a much smaller portion of our client's pie, but just because it's smaller doesn't mean that it's not important. Alternatives include precious metals, hedge funds, and commodities. Next, looking on the real estate side, again, looking at this theoretical client, we might make an allocation for them that would include 50% into our Canadian hard asset real estate pool, 30% into our US version of the same, and lastly, a 20% allocation to REITs, or publicly traded real estate income trusts. Again, as a system, what we expect out of these assets is they'll pay cash flow somewhere in the range of 5 to 7% of capital invested. Next, on the equity side, a 40% allocation to Canadian equity, 25% to US, 20% to global, and lastly, 15% to private equity. Again, a range of the amount of income or yield they produce, but on average, again, roughly 4%. Now, Jason mentioned at the start, we launched our private equity fund in June of last year. Now, we've been investing directly into various private equity funds for our clients for a number of years, and it's been very successful, but there's a reason why we wanted to put all of these funds together in one pool. And let me cover off the reasons why. Our private equity fund is a combination of fund of funds and a co-investment in private equity and mezzanine financing. And it's this third bullet point here that's the real key point. What you can expect out of private equity is, over the long term, a 5% or greater annualized outperformance over what you get investing in publicly traded equity. The trade-off, of course, is liquidity, but this is a trade-off that we feel is worth it if you're a long-term investor. Currently, we have capital commitments in our private equity fund of $24 million, and that's across 6 private equity funds. Now, to invest individually into any one of these private equity funds, a number of them have a $5 million minimum hurdle. By doing this as one pool for our clients, this has allowed us to bring down investment minimums to as little as $25,000 for each of our clients. Jason showed in his introduction some of the big pension funds. This is an outtake of that slide. Canada Pension Plan currently has a 16% allocation to private equity. Ontario Teachers Pension, 9%. And lastly, I actually pulled this just off of Harvard's website. This is their update for 2013. Harvard currently has a 16% allocation to private equity. They only have an 11% allocation to US domestic publicly traded equities. On a related front, infrastructure. Infrastructure is an asset class that we would really like to give our clients exposure to. That means owning a bridge, a toll, a dam. Infrastructure assets are very long-lived, but most of the best infrastructure managers around the world have very high investment minimums, typically somewhere in the neighborhood of $10 million. In addition to that, one of the challenges with infrastructure, even more so than investments in private businesses, is that these assets have very long lifespans and they're illiquid. Bridges last 50+ years. As well, some of the other complexity and challenge is infrastructure assets are normally structured as a P3 or a public-private partnership. But despite some of the challenges on infrastructure, we think the trade-off's worth it. With infrastructure, unlike private equity, you often have early cash flows right from the very beginning, a 5% cash flow on some of these assets. In addition to cash flow, they're conservative assets because they're so long-lived. And lastly, there's inflation protection on these assets. And it's for these reasons that we're looking to add infrastructure assets to our private equity pool. And we've narrowed down our list to 3 managers, with a most likely addition to our private equity pool coming at some point this year. All right, so when we circle back to where we started from a top-down, big-picture perspective, and then you drill down, you can see that there's a lot going on behind the scenes. And these pieces are constantly moving, and adjustments to these various allocations are required. But again, when you look at it as a system, in addition to the diversification, broad diversification that we want that cash flow. That's extremely important.